Hey CMA buddies, today we are going to continue with the chapter cost of capital, and the topic of our discussion today will be cost of preference share capital. Now preference share capital or the preference shareholders are paid dividend at a rate which is mentioned on the face value of the preference share, right? So that means if for example a preference share face value is say 100, in that case the dividend is paid on this rupees 100 and say the rate of dividend is at 10%, in that case dividend becomes 10 rupees, right? Please remember it's on the face value and it is not on the, and the premium or the discount factor should not be taken into consideration, right? Okay, it is not mandatory for a company to pay a dividend, and also remember if a dividend is paid, in that case they are prioritized over the equity shareholders. That means if dividend is paid, first the preference shareholders needs to be paid and then only the equity shareholders will be paid, right? Dividend in case of preference shareholders are not charged as expenses but are paid from after tax profit. So it means what? It means that as we read in the case of debentures, there is a tax shield that the debenture holders get. Preference shareholders are not getting any kind of tax benefit because they are paid only from after tax profit, right? So it does not reduce any tax liability for the company. Okay, going forward we see that preference share capital is basically divided into two parts. One is irredeemable preference share capital and redeemable preference share capital. Irredeemable preference share capital means what? The preference share capital that cannot be redeemed at a future point in time. That means only dividend will be paid on it. Whereas in case of redeemable preference share capital, the preference shares are redeemed after a certain period of time. So that means we will be paying dividend per annum, and whatever amount has been borrowed has to be repaid back either at premium or at par or at discount at somewhere down the line. Although it's not repaid at discount, it's basically at par or a premium, right? Okay, let's look at the computation. How do you compute irredeemable preference share capital? The formula is similar to how we read about the irredeemable debentures. It's PD divided by NP. PD here stands for the annual preference dividend, right? The dividend that the company pays per annum, and the net proceeds divided by net proceeds, that is net proceeds from the issue of preference share. The explanation is still the same. I'll just reiterate once again. Please consider net proceeds to be the amount that's borrowed from the public, say 100 rupees, and supposedly you are paying 10 rupees on this amount that's being borrowed. Hence the cost of capital becomes 10% for me, right? So that's how you compute the irredeemable preference share capital, right? Okay, now some important points to look into. Whenever we talk about this net proceeds is nothing but it's basically issue price less issue expenses, or what we call as a flotation cost. Okay, what is a flotation cost? We have already discussed in the last video. Flotation cost is nothing but the cost that is paid towards the issue of the preference shares. What are the issue expenses that a company may incur? They may have certain legal charges, or they may incur some administrative charges towards the issue of the preference share. So these charges are to be deducted from the flotation cost, right? Please remember, it's very important in terms of flotation cost that flotation cost is always computed on the issue price and they are not on the face value, right? Here in this case we saw that whenever we talk about dividend, it is always calculated on the face value, right? But whenever we calculate flotation cost, it's on the issue price. So for example, if you have issued a preference share on say a premium of 10%, right, and the face value is say 100 rupees, so that means the value of this preference share or the issue price of this preference share is 110, right? The flotation cost is always computed on this 110 and not on this 100. So please keep that in mind. Also, we have already discussed this in debentures also. The same is applicable in case of preference share. If issue price is not given, then we assume it to be equal to current market price. Or rather we can say that when two costs are given, that is issue price as well as the current market price is given, in that case the priority is always given to the current market price. Fine. Okay, let's move on to the next preference share capital, or the type of preference share capital, that is cost of redeemable preference share capital. Redeemable means what? Something which has to be repaid after a certain point in time, right? So how do you compute this? Computation is same as we did in the case of redeemable debentures. You pay annual dividend, that is D, right? plus RB, that is redeemable value, the value that needs to be repaid back, minus NP, that is the amount that's being borrowed by the company, and this is distributed over a period of time. What is this period of time? This period of time is nothing but the time that is mentioned while the issue of the preference share, that is N, right? And this is whole divided by RB plus NP by 2, that is redeemable value plus net proceeds divided by 2. Why by 2? Because there may be uneven cash flow in case of redeeming and while receiving the net proceeds, right? Since these cash flows are very uneven in nature, so we generally tend to average this out. Let's understand with an example. For example, the preference share capital was issued at say 100, but they are supposed to be redeemed at rupees say 110. Since this cash flow is very uneven in nature, so at the time of redemption, it will be 110, whereas when it was received it was only 100. So we have to average this out. Hence we divide this by 2. Right? So this is the formula for redeemable preference share capital. Okay. Now when we talk about redeemable or the irredeemable preference share capital, there may be cases wherein the company is supposed to pay a certain dividend tax on this, right? So let's understand how to compute this tax. Okay. Now for example, say the question says that you are supposed to pay a dividend tax on the dividend, right? So how do you compute this? Say for example, the tax rate is given as 10%, right? This is the actual tax rate that the company is supposed to pay, and there is a surcharge that's to be paid on that. So say surcharge is 2.5%, right? So when you add this both, it comes to be 12.5%. Now over and above, you're supposed to pay something called as a education cess or a secondary and higher education cess, right? Say for example, this education cess rate that we are talking about is say 3%, right? So this 3% has to be computed on this 12.5% and not on this 10%, right? I'll repeat that once again. This education cess that you are computing, or any kind of cess that you compute, you are supposed to calculate it on the tax rate plus the surcharge, right? So 12.5%, 3% of 12.5% becomes how much? This becomes 0.375%, right? So if you just add this both, the value of the same would be 12.5 plus 0.375. Hence the rate of tax that is supposed to be paid will be 12.875%, right? Okay. So the question will categorically tell you whether there is any tax on dividend or not. If the dividend tax is applicable, in that case you have to change the formula a bit. In that case, the formula for irredeemable preference share becomes what? Irredeemable preference share in that case becomes dividend, that is the annual dividend you are paying divided by NP. That continues to be the same as it used to be. It's just that your dividend needs to be multiplied with the tax rate, so it becomes into 1 plus DT, right? Same is the case with redeemable preference share. Usually the formula is KP is equal to D plus RB minus NP by N whole divided by RB plus NP by 2. But if a dividend tax component is given, in that case you are supposed to add the dividend tax component to the dividend part. So it becomes D into 1 plus DT plus RB minus NP by 2, that is redeemable value minus net proceeds divided by N whole divided by RB plus NP by 2, right? So that's all about today. Hereafter in next class we will be looking at the various questions on the preference share capital. Thank you for joining.